Welcome back to the embedTalk podcast, your companion for practical insights on engineering, tech, careers, and the mindset you need to grow. Every week, we break down real-world concepts and experiences to help you understand, learn, and make smarter choices for your future. In today's episode, we're diving into an important topic, so let's transition into the main conversation, presented in a narrative format designed to help you connect with the ideas more clearly.
I want you to just picture this for a second. You're standing at a coffee shop in Mumbai, right? And it's back in 2015. You just want a simple cup of coffee.
Right. Something we all do every day.
Exactly. But you try to hand over cash, and the vendor is just shaking his head because he doesn't have exact change. So you're like, all right, I'll use my credit card.
Which is an immediate problem because he probably doesn't have a card reader.
Yeah. He can't afford that expensive terminal or the fees. So your card is basically a useless piece of plastic. And if you actually wanted to be digitally back then, you had to log into this incredibly clunky bank portal on your phone.
Oh, yeah. Typing in all those massive routing numbers and branch codes.
Right. And then you just stand there and wait, sometimes for hours, or even until the next business day, just for coffee transfer to clear. It's wild.
Yeah.
That highly fragmented, deeply frustrating reality was the daily friction of payments in India less than a decade ago.
It really was. It was a massive structural bottleneck for the whole economy.
But today, that exact same transaction takes literally 1 second. It costs the merchant absolutely zero in fees. And all you need is a quick scan of a QR code that's just like printed on a piece of paper taped to the wall.
It's honestly one of the most incredible infrastructural leaps of our lifetime.
Which is exactly why we're doing this deep dive today, specifically for you, because I know you love a good aha moment without all the heavy jargon. We're looking at a February 2026 case study published by embedTalk, and it's called India's UPI Revolution, Changing How People Pay Online.
It's a fantastic source. Really gets into the weeds of the mechanics.
Yeah, and our mission today is to understand how a single technological framework fundamentally rewired the economy of the world's most populous country in under a decade. And, what the rest of the world can actually learn from it.
Mm-hmm.
Okay, let's unpack this.
So to really understand the sheer scale of this transformation, we have to kind of zoom out and look at the structural reality of India's economy before the Unified Payments Interface, which we'll just call UPI before it even existed.
Right, because cash was basically king. Right?
Oh, absolutely. India relied heavily on physical cash. Now, there were legacy digital systems in place. You had this thing called NEFT, which handled batch transfers. But, because it batched them up, clearing could take hours.
Not ideal for buying groceries.
Exactly. Then you had IMPS, which was technically instant, but it was just so clunky for the average user. It required all this complex pre-registration. And of course, you had traditional debit and credit cards, but
those rely on that heavy hardware we talked about.
Right. And for a low-end merchant, say, a street vendor selling fruit, the friction of setting up a merchant account, paying rent on a physical reader, and giving up like 2 to 3% of every sale, it made it completely unviable.
So they were basically locked out of the digital economy.
Completely. So the Reserve Bank of India, their central bank, and a not-for-profit industry group called the National Payments Corporation of India, or the NPCI, they realized they had a massive problem. Patching these old fragmented systems just wasn't going to work for a population of over 1 billion people.
They needed a clean slate.
Yeah, they had to build an entirely new architecture from the ground up.
The tech itself is fascinating, and we'll get into it. But I feel like if we just look at the code, we miss the whole story. Because you could build the fastest payment system in the world, but that doesn't mean anyone is actually going to use it.
No, people are creatures of habit. If cash works, they stick with cash.
Right. And the case study points out that UPI required a very specific kind of perfect storm of environmental factors to take root. And it starts with this thing called the Jam Trinity.
Yes, the Jam Trinity. This was the foundational public policy push that really made everything else possible. It stands for Yandan, Aadhaar, and mobile.
Okay, let's break those down. Yandan is the bank account part, right?
Exactly. It was a massive government initiative to get unbanked citizens to open basic, no-frills bank accounts. I mean, they brought hundreds of millions of people into the formal financial system almost overnight.
That is staggering. And Aadhaar, that's the ID system.
Yeah, Aadhaar is India's biometric digital identity system. It provides a unique, verifiable digital ID for every single resident, and it's linked directly to their fingerprints and iris scans.
Wow, so you can't fake it.
Right. And then the M is mobile. That was the push to link these new bank accounts and digital identities directly to people's personal mobile phone numbers, because data and smartphones were rapidly getting cheaper in India at the time.
So when you integrate those three pillars, you suddenly have this vast population equipped with a verified identity, a place to store digital money, and a connected device in their pocket to authorize moving that money.
Exactly. They basically wired the entire country for digital finance in just a few years.
Okay, so they built the roads, but how did they get everyone to drive on them so fast? Because having a bank account on your phone doesn't automatically change your daily behavior if you've been, buying your groceries with physical rupees for 40 years.
Right. And what's fascinating here is how external events acted as a catalyst. Timing really is everything. In late 2016, India experienced this massive, unprecedented economic shock called demonetization.
Oh man, I remember reading about this. It was wild.
It was. The government just unexpectedly announced that the two highest denomination banknotes, which, by the way, made up about 86% of all the currency in circulation, they were suddenly no longer legal tender.
So overnight, practically all the cash in the country just vanished from everyday use.
Literally. There was this desperate, immediate lack of physical cash. Citizens and businesses were essentially thrown into the deep end of the pool. They had to find digital alternatives instantly just to conduct basic daily life, buying food, paying for the bus, keeping their shops open.
And UPI was launching right into this exact window of desperation.
Exactly. It offered a service that completely bypassed the need for expensive card terminals or slow bank portals.
And the private sector totally saw that desperation and just ran with it. The source material talks about how these massive tech companies, Google Pay, PhonePe, Paytm, they all jumped onto this new platform.
Oh, the marketing push was incredible.
Yeah, they started aggressively competing for users by offering these wild financial incentives. Like you download the app, send a few rupees to a friend, and the app would just instantly reward you with a cashback bonus.
Which created this incredibly potent viral growth loop.
Right. You download it for the reward,
Right.
but then you realize, wait, I can pay my local grocer with a single tap, and the grocer realizes, hey, I don't have to handle dirty cash or run to the bank for change anymore, and the network effect just completely takes over.
But, desperation and marketing budgets, they only get you so far. If the technology itself was frustrating, people would have abandoned it the second that physical cash became widely available again.
That's a really good point.
We have to look at the mechanics of how UPI actually solved the payment problem better than a traditional digital wallet or a credit card. And the architectural genius of UPI is that it is fundamentally an account-first model rather than a wallet model.
Okay, here's where it gets really interesting. Let's break down the difference there. Because if I'm using like a traditional digital wallet app, my money is just sitting in a silo.
Right. Think about the friction of a standard digital wallet. You have to actively move money out of your actual bank account, load it into the third-party app's virtual wallet, and only then can you actually spend it.
So the app is basically acting as a middleman holding your funds.
Exactly. UPI skips that step entirely. It sits as this ultra-fast routing layer directly on top of India's banking infrastructure, specifically on top of that IMPS system we mentioned earlier. When you make a UPI payment, the money is pulled straight from your bank account and deposited instantly into the receiver's bank account.
Real money, real time.
Yes. There is no middleman holding the money. The transaction is final, immediately. Contrast that with a traditional credit card transaction, which operates on what the industry calls a T+2 settlement cycle.
Meaning the merchant doesn't actually see the cash in their account for 2 days.
Exactly. When you swipe a credit card, the network basically just sends an IOU to the merchant's bank. The actual physical funds take a day or two to clear and settle.
And for a big box retailer, whatever, that's fine.
Right, but for a street vendor who needs today's earnings to buy tomorrow's inventory, a 2-day delay is catastrophic. UPI provides real-time instant settlement directly into their bank account.
And the user experience described in the embedTalk study is just unbelievably simple. It is basically the equivalent of sending a text message. You don't need to know the vendor's bank name or their routing number or anything like that.
No, all you need is a virtual ID, which functions almost like an email address for your bank account. Or you just open your camera and scan a QR code.
But wait, hold on. I need to push back on this architecture a bit.
Okay, go for it.
You have dozens of traditional banks, you have the central bank, and you have these fierce, massive tech competitors like Google Pay and PhonePe all operating at the exact same time. If Google and PhonePe are fighting to dominate the market, why wouldn't Google just build its own closed proprietary network to lock people in? Similar to how Apple Pay operates in some ecosystems.
That's the million-dollar question.
Right. Why agree to play on this neutral plumbing at all? Isn't it just a chaotic free-for-all?
It's not, because the Reserve Bank of India and the NPCI mandated an open API architecture. An API application programming interface is basically a standardized mechanism that allows different pieces of software to communicate.
Okay.
Think of it like a universal electrical grid. Before UPI, every payment app needed to build its own specific plug and socket to connect with every individual bank. It was a nightmare. The NPCI essentially stepped in and built a universal electrical outlet.
Oh, shit.
Suddenly, it didn't matter if you were a Google toaster or a PhonePe microwave, right? You could plug into any bank's wall and draw power instantly.
So the government essentially forced interoperability. You literally can't build a walled garden.
Right. The NPCI handles all the complex plumbing, the routing, and the final settlement of funds in the background. They set the universal rules. Because this language is perfectly standardized, any bank and any third-party app, which the system calls payment service providers, or PSPS, they can just plug right in.
So the infrastructure is neutral?
Completely. The regulatory environment effectively said, look, we, the public utility, will handle the underlying financial rails. You, the private tech companies, can go out and fiercely compete on who has the best user interface, the best customer service, and the smoothest app design.
It separates the plumbing from the paint job.
Exactly. Google Pay couldn't build a walled garden because the underlying market of hundreds of millions of newly banked citizens was only accessible through this universal grid.
And because that architecture was so frictionless and open, the resulting scale absolutely defied all expectations. I mean, the numbers in this case study are just mind-boggling.
They really are hard to wrap your head around.
Yeah. By mid-2025, the UPI network was recording 19 to 20 billion transactions in a single month.
In 1 month.
1 month. The daily transaction values were hitting tens of thousands of crores, which is tens of billions of dollars equivalent every single day. The text points out that this scale rivals, and in some metrics completely beats, mature global card ecosystems that have been building their networks for decades.
It's incredible. But if we connect this to the bigger picture, looking past the server loads and the technical metrics, what we're really talking about is a fundamental societal earthquake in daily human behavior.
Yeah, the real-world impact.
Exactly. Look at the displacement of cash. A rural tea shop owner previously had zero chance of accepting digital payments because of the hardware costs, the internet requirements, and those interchange fees we talked about. With UPI, what does that tea shop owner actually need to accept a digital payment?
Literally a piece of paper. Just a printed QR code taped to the wall.
That's it. Anyone with a smartphone can scan it and transfer funds instantly.
It effectively formalizes the informal economy. Think about all the things you typically use loose cash for, right? Tipping a delivery driver, paying a domestic worker, or sending a little bit of money to a family member in another city.
Things that used to be totally off the grid.
Right. Suddenly, all of those invisible microtransactions become instant, trackable, and secure. It brought massive financial inclusion to millions of people who had literally never used a digital payment in their entire lives. They leapfrogged right over the era of plastic credit cards and magnetic stripes directly into instant mobile payments.
And that rapid digitization changes the entire financial landscape for those microbusinesses. Because these merchants are now generating a permanent digital footprint of their daily sales through these UPI apps, it makes it vastly easier for them to prove their actual income.
Oh, that's huge for getting credit.
Exactly. Previously, a cash-based street vendor couldn't prove to a bank that they made enough money to qualify for a business loan. It was just cash in a drawer. Now, they have a verified, minute-by-minute ledger of their cash flow. This digital footprint suddenly makes it possible for them to secure small business loans, buy insurance, or access merchant services that they were completely locked out of before.
Okay, but as with any system handling the economy of 1 billion-plus people, the case study highlights some serious growing pains and vulnerabilities.
Naturally, you can't scale that fast without friction.
Right. When you have 20 billion transactions flowing through a single ecosystem every month, it becomes a massive target. And reading through this, I have a major question about the sustainability of it all. It's what I call the profitability paradox.
Ah, yes. The economics of zero fees.
Exactly. The source explicitly states that the NPCI kept the transaction fees incredibly low, in many cases, absolutely zero,
Yeah.
specifically so that micro merchants would adopt it. But if the interchange fees are practically zero, how is the merchant acquiring side actually making any money? I mean, it costs millions of dollars to run servers at that scale. If Google Pay and PhonePe aren't taking a cut of the transaction, how do they survive?
You're pointing to a major structural challenge outlined in the embedTalk study. Traditional payment networks make their money on interchange fees, skimming 2 or 3% off the top of every swipe. In the UPI model, that interchange revenue is severely strained or just completely non-existent.
Right, which is great for the merchant, but terrible for the app.
The low fees were absolutely critical for getting merchants to adopt the system, but they destroy the traditional business model for the apps, so they are forced to pivot.
So how do they keep the lights on?
Through data and value-added services. Because these apps are processing all your daily transactions, they have an incredibly rich, granular view of your financial behavior. They know exactly how much you spend, where you spend it, and when you get paid.
So the data is the product.
Yes. They use that data to build highly accurate credit profiles. The apps themselves might not make money on the instant transfer for your coffee, but because they know your financial habits, they can offer you a microloan exactly at the moment you are trying to make a larger purchase.
Sneaky, but brilliant.
They make their money by taking a cut of the interest on that loan, or by selling you insurance, or by taking a commission on mutual funds sold right there through the app. They have to shift from being just a dumb pipe for moving money to becoming a comprehensive financial marketplace.
That makes total sense. But it's not just profitability that poses a risk to the system. There's the sheer volume of fraud.
Right. And it's really important to understand the mechanics of this fraud. The underlying rails of UPI, the cryptographic technology actually moving the money between banks, are highly secure. The vulnerability lies almost entirely with the humans using the system.
Because we are notoriously gullible.
Unfortunately, yes.
Yeah.
The case study highlights a massive rise in social engineering fraud. This involves phishing or vishing, where malicious actors call up a user, pretend to be a bank official or a merchant, and trick the user into manually authorizing a payment.
And because the settlement is instant, there's no going back, right?
That is the danger of real-time settlement. With the credit card, you have a couple of days to realize you've been scammed, call your bank, and issue a chargeback before the funds actually settle.
You have a buffer.
Exactly. With UPI, if someone convinces you to type in your secure PIN under false pretenses, the money is pulled from your account and deposited in theirs instantly. It's just gone.
Wow.
And beyond individual fraud, there is another massive systemic vulnerability that comes with this architecture: concentration risk.
You mean having a single point of failure?
Precisely. The NPCI, acting as the central neutral plumber, is UPI's greatest strength in terms of efficiency and interoperability. But it is also a massive single point of failure.
If the plumbing bursts, the whole house floods.
Exactly. If there is a major operational outage at the NPCI's server farms or a highly sophisticated cyber attack that takes their central switch offline, it doesn't just inconvenience a few users. It creates a massive bottleneck that could freeze the entire Indian digital economy for the duration of the outage. You would have millions of people suddenly unable to buy groceries or pay for transport.
But to be fair to the engineers running this, the text does outline some incredibly robust security countermeasures built into the design to mitigate these risks. It's not the Wild West out there. For one, the system relies on mandatory device binding.
Yes. Let's explain how device binding works mechanically, because it's a brilliant piece of security. When you set up a UPI app on your phone, the app doesn't just ask for a password. It actually performs a cryptographic handshake with the physical hardware of your specific phone and your specific SIM card.
So it's locking my account to my actual physical device.
It binds your digital identity to that piece of physical silicon.
Meaning a hacker can't just, steal my password in a data breach and log into my UPI account from a laptop halfway across the world.
Exactly. Even if they have your password, if they don't have the physical phone in their hand, the transaction will be blocked. On top of that, you have to enter a specific offline UPI PIN for every single transaction.
So that's two-factor authentication right there.
And it doesn't stop there. The NTCI and the banks are continuously deploying machine learning risk engines behind the scenes. These AI models are analyzing millions of transactions a second, looking for suspicious patterns. If a user who normally buys tea in Mumbai suddenly tries to transfer a massive sum of money to an unknown account in another state at 3 a.m.,
The system is going to throw a red flag.
exactly. It will flag it and require secondary two-step verification before the money moves.
It's a constant arms race. Which kind of brings us to how the system is adapting for the future. Despite these risks and growing pains, the architecture is not static at all. To solve those profitability issues and to keep expanding, UPI is evolving far beyond just simple peer-to-peer payments.
Right. We are seeing the rollout of what they call UPI 2.0. The architecture is expanding its vocabulary. For instance, they introduced a feature called auto pay. This handles pre-authorized recurring mandates.
So like subscriptions.
Yes. Think about your own monthly subscriptions, streaming services, utility bills, or even automated monthly investments. Right now, you probably rely on a credit card to handle those recurring charges. UPI 2.0 allows you to authorize the network to pull those funds directly from your bank account on a set schedule, completely bypassing the card networks.
And the really big shift mentioned in the source is the integration of credit. They are heavily experimenting with bringing buy now, pay later models and even direct credit lines straight onto the UPI rails.
Which is a game changer for consumer spending.
Totally. What this means in practice for you, the listener, is that UPI is turning into what the fintech industry calls embedded finance. Payments are no longer just the final, boring step of a transaction. They are becoming the frictionless gateway to everything else. You scan a QR code for a refrigerator, the app knows you don't have the cash in your linked account, but it instantly underwrites a microloan for the exact amount based on your transaction history, and you walk out of the store.
Borrowing, saving, and insuring are all happening within the exact same swipe on your phone.
It's wild.
And this raises an important question for the rest of the world. What can policymakers in other countries actually learn from India's success? The case study synthesizes a few critical structural lessons here.
Okay, lay them out for us.
First, you need neutral industry governance. Having a not-for-profit entity like the NTCI run the core plumbing kept access completely open and prevented a monopoly from jacking up prices. Second, open standards are absolutely non-negotiable.
Right, you can't rely on walled gardens if you want true national adoption.
Exactly. Standardized APIs allow the entire ecosystem of banks and tech companies to innovate fiercely on the user experience while ensuring their software can still talk to everyone else's. And third, you need coordinated public policies.
The jam trinity.
Yes. UPI simply wouldn't have worked without the foundational identity infrastructure of Aadhaar and the aggressive banking push of the Jan Dhan accounts. You have to align the broader regulatory environment. You can't just launch a clever app and expect it to magically change an economy.
And looking to the horizon, the text notes this massive push toward international interoperability. They're trying to link UPI's rails with fast payment systems in other countries. The ultimate goal is cross-border remittances making, sending money from a worker in London to a village in India, as easy, instant, and practically free as buying a cup of tea in Mumbai.
It's really a masterclass in designing for scale.
It really is. So to wrap up this deep dive, we've seen how India's UPI went from a government-backed modernization initiative to an absolute juggernaut processing 20 billion transactions every single month. And they achieved this by relentlessly prioritizing a flawless, single-click user experience, mandating practically zero fees to bring millions of micro-merchants on board, and utilizing a brilliant open API architecture that forced the world's biggest tech giants to compete on customer service, rather than locking up the underlying infrastructure.
It completely flipped the script on how financial technology should be deployed.
Exactly. So the next time you find yourself tapping a plastic card waiting for a chip reader to process, or fumbling with a clunky proprietary payment app, think about how a unified, open-source approach like UPI could entirely rewire the efficiency of your own local economy.
And, as we consider that highly efficient future, there is one final, somewhat provocative thought hidden in the source material that is really worth debating.
Oh, I love these. What is it?
The text touches briefly on the horizon of what it calls smart mode payments and AI. It notes that as these instant payment systems evolve, the incredibly rich data flowing through them will allow artificial intelligence to provide dynamic, real-time, personalized offers and instantaneous risk scoring based entirely on your unique payment behavior.
Wait, so you're saying the app knows I want to buy a pair of shoes, knows I don't currently have the cash in my linked account, and the AI just steps in to offer me a perfectly tailored loan right at the exact moment I scan the code.
Exactly. And the AI is instantly scoring your risk based on its analysis of your past 5,000 tea, grocery, and utility purchases.
That is, wow.
It poses a fascinating dilemma about human behavior. If an instant payment network becomes so technologically advanced that artificial intelligence starts perfectly predicting your needs, offering tailored goods, and instantly financing those purchases at the exact moment of your desire, all with zero friction, do we risk losing our own financial autonomy?
That is a terrifyingly frictionless concept. I mean, if it becomes mathematically too easy to spend money, if every barrier and every moment of hesitation is just removed by an algorithm designed to finance your impulses instantly, does the sheer ease of spending eventually override our conscious human ability to save?
In a completely frictionless, AI-driven economy, it's a real risk.
A completely frictionless world might just be a little too slippery. It is certainly something to think about the next time you reach for your phone to buy that cup of coffee. Thank you for joining us on this deep dive. Keep questioning the world around you, and we'll see you next time.
Thank you for listening to this episode of the embedTalk podcast. If you enjoyed today's insights, don't forget to follow or subscribe on YouTube, Spotify, or wherever you listen to podcasts. Share this episode with someone who might find it useful and help us grow this learning community. For more articles, quizzes, and deep dives into engineering, business, and emerging technologies, visit us at embedtalk.com. Until next time, stay curious, keep learning, and continue exploring the future with embedTalk.